Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Peter Lynch, former manager of the Fidelity Magellan Fund, is widely regarded as one of the most successful stock market investors of all time. During his tenure from 1977 to 1990, he delivered an average annual return of 29% for his investors, making the fund one of the most best-performing mutual funds of all time. Lynch's investment philosophy and strategies are outlined in his book, One Up on Wall Street, which was first published in 1989 and remains a classic in the field of investing today. In this video, we will provide a comprehensive overview of the key concepts outlined in this book and how they can be applied to achieve investment success for you. We will explore the key concepts of Lynch's investment philosophy, whilst examining his approach to identifying undervalued stocks, performing a thorough analysis of a company's financial statements, and evaluating industry trends. Through real-life examples and worked-out illustrations, we will demonstrate how Lynch's investment strategies can be applied by individual investors to potentially achieve financial success. Lynch's investment philosophy is based on the principle of investing in what you know and understand. He suggests that individual investors are often better equipped to identify undervalued stocks in industries they are familiar with, compared to professional investors who are more focused on broad market trends. Lynch encourages investors to draw upon their own personal and professional experiences and observations to identify stocks that may be undervalued. For example, he describes how he invested in Dunkin' Donuts, a company he discovered while driving his wife to a medical appointment. He noticed the long lines at the drive-thru and decided to investigate the company further. He found that Dunkin' Donuts was a well-run company with a strong brand and loyal customer base, and therefore invested in the company, which turned out to be a highly profitable investment for him. Another example is Lynch's investment in Hanes, a company he discovered while shopping for underwear. He found that Hanes was a well-known brand with a dominant market share in the underwear industry. He invested in the company and achieved significant returns. He suggests that investors should focus on companies with strong brand recognition and loyal customer bases, as these companies have a competitive advantage that can help them weather economic downturns and remain profitable in the long term. By investing in what you know and understand, individual investors can identify undervalued stocks and achieve financial success. He goes on to explain that investing in undervalued stocks with strong growth potential is also the way forward. He argues that the key to successful investing is identifying companies that have the potential to grow and increase their earnings over time, and whose stocks are currently undervalued by the market. Lynch suggests that investors should focus on companies that have low price to earnings ratios, or PE ratios, which indicate that the company's stock is currently undervalued by the market. He suggests looking for companies with strong earning growth rates, as these companies have the potential to increase their earnings and stock prices over time. For example, he describes how he invested in the retailer group Gap, which had a low PE ratio of 7 at the time. He recognised that the company had strong growth potential over the long term, as it was expanding rapidly and had a successful track record of opening new stores. He therefore invested in the company, and hey, the rest is then history. Another example is his investment in the trucking company Roadway Express, which also had a low PE ratio, this time of 8. He also recognised that the company had strong growth potential, as it was expanding into new markets and had a dominant market share in the trucking industry. He invested, and yep, you guessed it, the rest was history. As an investor, he also says that you should perform thorough analysis of a company's financial statements before investing. He suggests that investors should pay close attention to a company's balance sheet, income statement and cash flow statement, in order to gain a comprehensive understanding of the company's financial health and potential to grow. He suggests looking for companies with low debt to equity ratios, as these companies are often able to weather economic downturns and remain profitable. He also suggests looking for companies with strong cash flows, as these companies are able to reinvest in their businesses and pursue further growth opportunities in the future. For example, he invested in the cable company TCI when it had a low debt to equity ratio of 0.35 and strong cash flows. He recognised that the company had a solid financial foundation and was poised for growth, and therefore invested in the company, which again turned out to be a highly profitable investment. There's a bit of a theme coming here, isn't there? Lynch goes on to explain that evaluating industry trends and market conditions before investing is also critical. He suggests that investors should pay close attention to macroeconomic trends and technological innovations that may impact the industries in which they are interested. For example, Lynch invested in the tech company Apple in the early 1990s, when the company was still a relatively small player in the computer industry. He recognised that Apple had a unique business model and a strong reputation for innovation, and believed that the company was poised for growth as personal computers became more popular. He invested in the company, and the rest was history. Lastly, he suggests looking for companies that are positioned to benefit from macroeconomic trends, such as demographic shifts or changes in consumer behaviour. Again, another example, Lynch invested in the home improvement retailer Home Depot in the 1980s, when the company was still a relatively small player. He recognised that Home Depot was well positioned to benefit from the growing trend of do-it-yourself home improvement, and therefore invested in the company. And yes, you guessed it again, he invested, and the rest was history. So, in conclusion, One Up on Wall Street by Peter Lynch is a classic investment book that offers a wealth of practical advice for individual investors. Lynch's investment philosophy is based on the principle of investing in what you know and what you understand, whilst focusing on undervalued stocks with strong growth potential. He emphasises the importance of performing a thorough analysis of a company's financial statements and evaluating industry trends and market conditions before investing. Through real-life examples and worked-out illustrations, we've demonstrated how Lynch's investment strategies can be applied by individual investors to potentially achieve similar financial success. By investing in companies with strong brand recognition, low PE ratios, and strong earning growth rates, investors can potentially identify undervalued stocks and achieve significant returns over the long term. Overall, One Up on Wall Street is an excellent resource for individual investors who are interested in investing in the stock market. By following Lynch's investment philosophy and applying his practical advice, you can hope to replicate something similar yourself. And that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.